I don't like some buybacks that are done because they tend to buy back at the wrong time, right? They buy back their stock when it's expensive. They buy back less stock when it's cheap. But generally, if a company is paying most of its excess profits out as dividends on a regular basis, and they want to buffer, like, sometimes they want to get extra capital back, they can either do a special dividend or they can buy back shares around the margins. And it's generally a little bit more tax efficient to do the buybacks. So generally, companies that should be reinvesting and staying ahead of their competition, generally want them. I prefer them doing dividends, or focusing on growth, focusing on just maintaining their edge in more kind of steady state industries, railroads, insurance, banking, pipelines, things like that. Again, I think most of it should be dividends, and that buybacks essentially serve as kind of a flexible thing that they can do to take advantage of certain situations or to return excess capital to shareholders, because it eventually shows up in more dividend growth because they can spread their dividend payments over a smaller number of shares.
Yeah.
But I don't like it when they're abused, because when they're abused, it's just a way to prop up the share price.
Yeah, right.
So it really comes down to why management is doing it versus whether or not the whole concept is bad or not. Because if you think of it as a structural issue, I mean, if you had a company run by 10 people and one of them wants out, and they use cash flow to buy out that owner, so now the company's broken into 9 shares instead of 10, they each get 11% of the cash flows. That makes sense. There's nothing really wrong with it structured on a large level. It's just that what's wrong is the short-term planning that corporations do. Instead of investing long-term for the future, they're thinking how to optimize a couple quarters ahead. And a lot of times the answer is buybacks. Well, so I'm probably less concerned about the banks than the average bear is. Let's put it like that. So one is I'd be cautious about having more money than the FDIC insured amount in any specific bank account, for any length of time. Right. So you should diversify into that. You can go into treasuries, you can go into multiple different accounts, things like that. So people should be cautious. And as far as the bank sector as a whole right now, so it's interesting going back to the period in the run up to 2008. Banks had their lowest percentage of assets in cash and treasuries than they ever had, and they had most of their assets in loans, riskier securities, things like that. So they were very aggressively positioned. Basically, you'd have to go back to the 1920s to find a similar environment. And so that's kind of another echo from that period I talked about before. Whereas ever since the global financial crisis, when you saw basically partly it's regulations, but mostly it's banks just not, they're managing themselves different. They're being far more careful with their lending standards. And so they basically have been more conservatively positioned into cash, into treasuries, higher thresholds for what kind of loans they do, what kind of securities they buy. And so, for example, right now, banks have a historically very high allocation, the percentage of their assets that are in things that nominally can't lose value, like treasuries and cash. And they have a smaller allocation than they normally had to loans and other things that can lose purchasing power. Now, they are facing cyclical recessionary pressures. So they're allocating more money towards loan losses. They're expecting an uptick in loan losses, which will eat into their profits. So I do think that in a cyclical sense, they are facing, I think, recessionary pressures like any other industry. The difference is that in 2008, the problem emerged from the banking sector largely, whereas I don't view this recession as being very bank focused. Basically, they're not like over their skis in a similar way that they were in the run up to 2008. But if you look at overall kind of numbers, the banking sector as a whole is very mortgage focused. It's very commercial lending focused. And things like auto loans are kind of like icing on the top of the cake. It's like a small layer. And of course, there are certain banks that are heavily exposed to those. Those are generally trading very cheaply right now because there's obviously, there's kind of blood in the streets there, or the kind of the potential for that to happen. So I do think there are obviously pockets of problems, auto loans, consumer loans, things like that. Whereas when you look at the average kind of large, medium-sized bank, those types of loans represent a very small percentage of their book. Whereas a larger percentage of their book is elsewhere. So yeah, there's certainly pockets of more severe stress. Essentially what we're seeing is a contraction in both supply and demand, where, existing home supply, nobody wants to sell. Also, nobody wants to buy at these higher rates. So even though we've seen a huge uptick in mortgage rates, we've seen very little change in effective mortgage rates because almost none of these, higher mortgages are moving. right? That's not really a place where people are buying and selling. They're kind of just locking in what they have now. And so I think we're seeing obviously more problems in the new home market. I think that's where we're going to see changes around the margin, whereas the overall situation is that a lot of cyclical markets are probably going to, they've already been running into problems. I think they're going to continue to be, kind of deflating. Linear markets, I think, are more kind of steady state. They're kind of locked into their current situation. And most of the pressure here takes the form of just lower buying and selling rather than necessarily lower prices, or at least, not necessarily material lower prices in those linear markets. So I think people that have an existing property with fixed rate debt, in a linear market, I think they're in decent shape. Whereas obviously the challenge is for people that are trying to buy a new home with financing. That's where the whole it's almost shut down. Basically, it's not good for new home construction in many ways, but it is good for companies that are servicing existing homes. People are expecting a massive crash in housing prices, and I think that those expectations are overdone because of how much of the supply is just not going to move. Yeah. And so only around the margins, only over time will some of that happen. Now, obviously, in some very excessive markets, very cyclical, bubbly markets, those come down a lot faster. Whereas the linear markets, basically, I think that to the extent that people have a reasonably priced home with a fixed mortgage, I think they're in pretty good shape. And it's really those people that work, that they rely on the activity of the industry. They're the ones that are mostly challenged. And so that ripples through everything else, because obviously then those people, they lose jobs, or they have less income, they go out and buy fewer things. It impacts those businesses. So we have basically the types of places that are losing their jobs are these more industry focused, sensitive industries. The same thing actually happened to tech in ways that surprise people. So we think of the housing market as very interest rate sensitive for obvious reasons, because it's very leveraged. Yep. Whereas in the tech sector, because unprofitable growth companies, right, they're very reliant on interest rates being low, because what they did was they would just issue tons of equity. And if the cost of capital is nearly nothing, if you're investing in this long-term promising idea, people pay up almost anything for it. And so they use that overinflated equity. That's how they pay their employees. The shareholders don't scrutinize their lack of profits. It's able to kind of grow. They don't have to raise their prices very fast because they're not worried about being profitable. Right. And so it actually supercharges their growth because they're able to undercharge as long as those conditions last, which they don't last forever. Yep. And so now that there's actually cost of capital, you see a sharp reduction in the valuations of these growth-oriented companies compared to value stocks that are just kind of chopping along like nothing happened. And so now those companies are raising prices because they have to be more profitable, because they can't just rely on constantly issuing new equity to their employees and things like that, which then slows down their growth, because some of their growth was just artificial to begin with, because they were purposely undercharging. And so you have a whole slowdown there, which results in layoffs, which then trickles through in other things. They laid off people, buy fewer things, they cut back. And so essentially that's what we're seeing, is that the overall economy is soft, but it's emanating from these industry sectors, from people that work in real estate, from people that work in tech, things like that, whereas restaurants are fine, many other types of businesses are fine, and only after a long enough period of time from less buying activity from these more sensitive sectors do you start to see a more broad-based recession.